This is ShadowQuant, Stocks, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 23, 2026, and this is the New York pre-market. Now, let's get into it. We are entering the trading day with a clear fracture in the market structure. Utilities are surging as the primary safe haven, while technology faces a violent unwind led by Google's pre-market gap down. The question this morning isn't whether the rotation is happening, it's whether the defensive bid in utilities has enough fuel to offset the liquidity drain in the Nasdaq. Looking at the schedule, today is dominated by earnings reports rather than macro data dumps. We have Thermo Fisher, TMO, Cleveland-Cliffs CLF, and Lockheed Martin LMT reporting, all of which are acting as bellwethers for healthcare, materials, and defense, respectively. Additionally, Albertsons Asahi is set to report, though we already know the outcome from their Q1 miss earlier this cycle. On the macro side, we are monitoring the 10-year and 2-year Treasury yields throughout the session to see if the yield curve steepens or remains flat. Apex, what stands out here?
The standout is the earnings cluster. TMO, CLF, and LMT represent the quality end of the spectrum. They are generating cash and raising guidance. Meanwhile, ACI represents the weakness end, having already shown how the market punishes retail stress. The macro data is static. This is a stock-specific grind. Watch how these earnings interact with the broader sector ETFs, particularly the industrial sector and the utilities sector.
Let's look at the board. As of 9/19 ET, the S&P 500 ETF SPY is at $747.41, down 0.12%. The Nasdaq QQQ is lighter at $705.35, off 0.51%, while the Dow Diamonds holds steady at $521.47, essentially flat. The Russell 2000, IWM, is under pressure at $293.79, down nearly 1%. Sector-wise, we see a massive divergence. Utilities, the utilities sector, are up 2.25%. Energy, the energy sector, is up 1.2%, and materials, the materials sector, is up 1.44%. Conversely, communication services are down 0.75%, and consumer discretionary are down 0.74%. Grid, where are we technically?
Price action at $747.41 for SPY is confined within the lower third of its 10-day range, which runs from $740.80 to $755.58. We are hovering dangerously close to the July 20 close support at $742.09, for QQQ at $705.35. We are trapped in a narrowing consolidation zone below the July 21 high of $708.97. Immediate overhead resistance is anchored at $710.05, and for IWM at $293.79, we are testing the lower bound of our 10-day range, with support at $292.68 looming if the $296.44 resistance fails repeatedly.
So we're seeing technical fragility, especially in the small caps. CIPHER, does the fundamental picture align with this technical weakness?
It does. The market is executing a definitive rotation from speculative growth narratives to tangible cash flow generators. Look at TMO, up 6.2%, and LMT, up 5.3%. These are strong Q2 results with raised guidance. They validate the defensive rotation thesis. Contrast that with SDM, which is gapping down 17.6% on a weak Q3 revenue outlook, or a SI, down 16.1% on an earnings per share miss. The market is punishing guidance misses and margin compression aggressively. We are seeing a shift where story stocks face reality checks against hard balance sheet metrics.
And Pulse, what is the sentiment driving this? Why is Google falling so hard? There is a classic sentiment trap playing out with Google. Both Goog and Google are gapping down over 5%, yet their news sentiment scores are surprisingly neutral at 0.5 and 0.6 respectively. This indicates that algorithmic and institutional flows are aggressively repricing risk based on unreported AI data center sentiment concerns rather than public discourse. The VIX is sitting at a deceptively calm 17.5, which means the market is currently mispricing the depth of the rotation away from growth. It's not just noise. It's a liquidity vacuum forming in high beta names like communication services.
Let's dig into the top movers. First up, the Google gap down. Both Goog and Google are off more than 5%. Pulse, walk us through that divergence.
As I mentioned, the disconnect between the minus 5.2% / minus 5.4% price action and the near zero sentiment scores is the key. The market is front-running fundamental shifts in AI capital expenditure expectations. The VIX at 17.5 hasn't spiked because the fear is being absorbed by the underlying equity structure, the gap down itself, rather than manifesting in options pricing immediately. But this is a leading indicator. If NVDA and MSFT, which still have bullish sentiment scores of plus 0.6 and plus 0.48, don't hold, this sentiment trap could widen.
SPECTER, does the VIX level of 17.5 give you comfort, or do you see a crack forming?
I see a vulnerability. The VIX closed at 17.5, down 1.6 points, but the 5-day range was 15.64 to 19.5. That contraction to the lower end is deceptive. It masks structural fragility where the 10-year minus 2-year yield curve spread is only plus 0.36 percentage points. With CPI at 3.46% and core PCE at 3.41%, the macro environment is stripping away the liquidity premium. A low VIX in a flat yield curve environment doesn't mean stability, it means complacency. If that curve steepens negatively, or if inflation data sticks, that 17.5 level can expand rapidly.
Second mover, CLF, Cleveland Cliffs, up 11.8% on stronger results. CIPHER, what's the driver here?
CLF is up 11.8% because they reported narrower losses and revenue growth. It's a pure cash flow play. In an environment where the Fed funds rate is held at 3.63% and inflation is sticky, investors are rewarding companies with visible margins and cyclical strength rather than future promises. This supports the industrial sector, which is up 0.11% today, even as the broader tech sector bleeds.
Third mover, SDM, down 17.6%. Pulse, is this isolated?
It's connected. SDM's minus 17.6% gap down reflects a collapse in semiconductor supply chain confidence. It's not just SDM, it's part of the broader tech fragmentation. While NVDA and MSFT sentiment remains positive, the weakness in SDM and Goog suggests that the growth at any cost era is under pressure. The sentiment isn't universally bullish anymore, it's highly selective. The market is rewarding quality, TMO/LMT, and punishing guidance misses, SDM/SI.
SPECTER, does SDMs drop signal a broader risk for the semiconductor complex?
It signals that the denominator effect of persistent rates is eroding the present value of future profits. SDM's drop is a rational repricing of AI data center ROI timelines in a high-rate regime. The market isn't overreacting to SDM. It's correctly identifying that without a widening yield curve or cooling inflation, high multiple tech is exposed. This isn't an isolated event. It's a symptom of the structural headwind grid mentioned earlier with the QQQ consolidation failure.
Let's focus on the primary tension, the rotation. Utilities, the utilities sector, are up 2.25%, while communication services are down 0.75%. Grid, how do we interpret this technical split?
The spread between the utility sector's strength and communication services' weakness validates the risk-off flow. For QQQ, the technicals are bearish. Price at $705.35 is below the July 21 high of $708.97, and resistance at $710.05 has rejected rallies for 3 consecutive sessions. The path of least resistance is toward a test of lower liquidity pockets. If QQQ fails to hold $703.62, we could see accelerated selling. Meanwhile, the utilities sector is operating in a different technical universe entirely, driven by inflows that are decoupling it from the broader beta of the S&P 500.
CIPHER, how does the fundamentals side explain this capital movement?
It explains it perfectly. Capital is moving from long-duration assets to short-duration, cash-rich entities. The cost of capital is elevated at 3.63%, with CPI at 3.46%. This structurally pressures high-multiple equities like those in communication services. Companies like TMO and LMT are showing us exactly how the market wants to be compensated right now, through verified profitability, not narrative. The rotation into the utilities sector and the energy sector is a hedge against the very real risk of economic slowdown hinted at by the flat yield curve.
Pulse, is the crowd buying into this rotation, or is it just institutional rebalancing?
It's institutional, but it's accelerating retail sentiment too. The negative sentiment around Goog is spreading to the broader tech narrative. However, note that NVDA and MSFT sentiment remains bullish. This suggests the rotation is selective, not systemic. But if that selectivity turns into broad rejection, the VIX, which is currently suppressed at 17.5, could spike. The fear is building in the price action, even if the volatility index hasn't caught up yet.
Let's move to the second major theme, small caps. IWM is at $293.79, down 0.93%, testing support at $292.68. Grid, what happens if that support breaks?
The daily close below $292.68 would invalidate the recent bounce structure and expose the $291.64 lows from July 17, given that IWM is testing the lower bound of its 10-day range, $291.64 minus $298.21. A break here triggers algorithmic selling into that region. It's a fragile level. If IWM cannot reclaim $296.44, the technical case for a deeper correction overrides the defensive rotation thesis for the broader market.
SPECTER, does IWM's weakness confirm your yield curve warning?
It does. IWM underperforms SPY by nearly 1%, which reflects heightened sensitivity to the cost of capital implied by the flat curve. Small caps are more leveraged and more sensitive to borrowing costs. Their underperformance is a leading indicator that the soft landing narrative is weakening. If IWM breaks $292.68, it confirms that the macro headwinds are hitting the most vulnerable parts of the market first.
CIPHER, do the earnings reports this week support the idea that small caps are struggling?
Yes, ACI's minus 16.1% drop is a leading indicator for retail and consumer stress. CLF's strength is notable precisely because it's an exception, a company with strong margins and cyclical tailwinds. Most small caps don't have that kind of pricing power in a high-inflation environment. The divergence between CLF and ACI tells us that fundamentals matter more than ever. Margins are being squeezed everywhere, except in sectors with absolute pricing power or government contracts like defense.
Apex, tie this together. We have a technical breakdown in tech, a fundamental rotation into value, and small caps under pressure. What is the synthesis?
The synthesis is that we are witnessing a structural liquidity squeeze. Grid flagged the QQQ failure at $710.05, and CIPHER showed how earnings quality, TMO/CLF, is being rewarded over speculation. SPECTER warned that the low VIX is masking yield curve stress, and Pulse confirmed that sentiment is deteriorating faster than volatility indexes capture. The result is a market that is actively selling beta, QQQ/IWM, to buy alpha in defensives, the utilities sector/the energy sector. The risk is that if the VIX expands from 17.5, it will exacerbate the selling in IWM and QQQ simultaneously.
Final thought on the Google situation. Pulse, is the minus 5% drop sustainable, or is it a dead cat bounce waiting to happen?
It's a repricing, not a bounce. The sentiment scores are neutral, but the price action is aggressive. Until NVDA and MSFT show similar weakness, this is contained to the Google ecosystem. But treat it as a leading indicator. If the broader tech sentiment shifts from bullish to neutral, the multiple compression accelerates.
CIPHER, final word on the rotation.
Hold the quality. TMO and LMT are the models. Avoid the guidance misses like STM and ACI. The market is paying for certainty, not promise.
To summarize the dynamic, grid observation of the QQQ consolidation failure at $710.05 is being validated by CIPHER earnings data, which shows a flight to cash flow. SPECTER warning about the VIX at 17.5 being a false calm due to the flat yield curve is reinforced by pulse sentiment data showing deteriorating tech narratives. The market is not resting, it is rotating. The support at SPY $742.09 is being tested by this rotation, not by broad panic, but by systematic deleveraging of growth exposure.
Here is the takeaway for the trading day. 1. Monitor the QQQ resistance at $710.05. A failure there confirms the bearish technical structure. 2. Watch the IWM support at $292.68. A break exposes smaller caps to further downside. 3. The rotation into the utilities sector and the energy sector is real and driven by fundamentals, but beware of a VIX expansion from its current 17.5 level as the yield curve remains flat. Tomorrow, we'll watch how these levels react post-earnings. Thanks for watching ShadowQuant Equities Edition. Stay disciplined. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Equities. Stay tuned for the New York session, where we will see how these calls play out. Until then, trade safe.